Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, November 29th, 5:20 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Bear market rally still underway. Really, the market is sitting and waiting on a big speech and Q&A session from Fed Chair Jay Powell tomorrow afternoon. Whole lot of nothing really going on today, just chopping around this key 3950 support slash resistance area. You can see over here on the trend gauge, leader still holding up okay. As far as the five major indexes go across the three time frames that we track short term, we are showing uptrend, but the NASDAQ 100 today broke below the 21-day exponential moving average. So is that just because it's weak, or are the other indexes going to follow suit? We'll know more tomorrow around this time when I do the video. Medium term, we're still above the 50-day moving average across all five of the major indexes. Long term, 200-day moving average still showing bearish. Mixed bag on what's above and what's below the 200-day moving average. The S&P below it, but the equal weighted S&P above the 200-day moving average. We don't really factor that into to our statistics here, but that again points to the weakness in the overall FANG stocks, and that was also evident today. What just happened today? Chop around 3950, Powell Wednesday afternoon. G6, this is our 6 ETF growth proxy, down just a fraction on the day. S&P 500 open flat, closed down 0.16%. NASDAQ 100 was the laggard today, down 0.8%. Dow just barely positive. Mid caps up 0.3%. So were small caps. Global diversified 60/40 stock and bond up 0.11%. Emerging markets and foreign stocks outperformed the U.S. today. And GROTECTION, our in-house portfolio, down 0.31%. Had got a couple more stops hit, and we took a profit on something, as post-trade review continues to point to the best course of action being taking profits when you got them and they're reasonable before the market takes them back. So let's dive into the charts and what we do here at Revere. We are a fee-only registered investment advisor, registered with the SEC. That means we manage over $100 million. Completely transparent. We do videos 5 nights a week and a podcast for the weekends. No conflicts. That means we have no products to sell you, just our services and our strategies. And I can summarize our strategies pretty quickly. Looking here at this chart of the S&P 500 over the past year, what we do is trend follow across 3 time frames. Our flagship portfolio is named GROTECTION and is designed to grow your assets during uptrends and protect them during downtrends. And during shades of gray in between, we have varying levels of exposure to the market depending on how growth stocks and various sectors are behaving. If we start to roll over as we did in the beginning of January, we're going to start protecting capital. If things accelerate to the downside, you'll see the slopes of the moving averages, that's the green line, and the red line start to roll over. Then we're really getting concerned, because if we break below this black line, the 200-day moving average, you should be familiar with this chart right now, the one that will keep you up at night if you are close to retirement and worried about your nest egg. Not at Revere. We've got rules to get out, rules to get back in. We completely dodged this January to October 27.5% sell-off. And basically our rules are we're especially risk management focused when we're below the 200-day moving average, because that's where all of these difficult market periods occur. If you can just get out of the way of those, wait for the market to get healthy again, then you can compound from a higher capital base, because you didn't give back 20, 25, 30 or more % of your nest egg. And right now we are in a key spot in the market. Several times this year, we tried to get back above the 200-day moving average, most specifically in April, again in August, and now again here in November, and we've been unable to do so on the S&P 500. So knowing that those statistics tell us that this is the time to be on guard, we limit our exposure to the market. We focus on the indexes as long as they're above their 21-day moving average. We will have exposure there, but if you're below the 200, we're not going to get overly exposed, and keep a close eye on stops on everything that we have in-house. And if you're interested in an approach like this, seems common sense, doesn't it? What other part in your life when things are going bad do you not take action? Give us a call. We can discuss the strategy with you. You can email me, don@revereasset.com, or my partner, Danny Stewart. That's dan@revereasset.com, or you can call us at 855-REAL-WEALTH. That's 855-732-5932. Let's go to the SPY here to show where today's tight range, less than 1%. But again, a lower low below the rolled over 8 EMA. If you look at any of the periods this year that we made substantial progress, and this goes for on the downside too, on the downside trending below the 8 EMA, on the upside trending above it, it's been pretty reliable. And when you break below it and the slope of the line rolls over, it's been an early warning that you might be visiting the 21 and possibly ready to break that. So with that in mind, yesterday we took a little bit more off the table. Today, making a lower low, we took a little bit more off the table. We also put a short on buying the inverse ETF for the NASDAQ 100 when it broke below the 21-day moving average today, getting even more defensive. Basically, post-trade review tells us we could have done a better job on the short side this year, just staying short on the different indexes while they're trending below the 21-day moving average. You get in close to it, you see if you can ride that trend lower. So that's what we did today. Tomorrow, if we take back off to the upside, we'll be out for a minimal loss, and the longs that we have that are offsetting this short will carry the portfolios higher. We've got that in six different positions still exposed to in-house, and we'll go over them when we go through the tail of the tape. Let's go to the Dow Jones Industrial Average right now. Still the leading index, little tight move sitting basically right on the 8 EMA today. The 8 EMA is flattening out. Another reason, let's go back to the S&P, to be concerned with the stochastic starting to roll over. Look at the prior periods when it's rolled over, broken below, overbought, and what has happened on the indexes. This is why we've always got one foot out the door at any sign of weakness this year. Sometimes it's cost us a little bit, sometimes it's saved us big time, but you can see the broad sell-offs that have taken place when you get in overbought territory and then start to roll over to the bottom. Now, maybe you chop, that's fine, we can do that. But either way, we'll stay exposed to near around what a 60-40 portfolio will be, unless we break the 21-day exponential moving average. That would indicate that stochastic and the price level is going to continue to, at a minimum, test the downside at the 50-day moving average around 3,800. Contrast that with last year, how the stochastic acts in a bull trend. Look how much time it spends in overbought. When you're in a bull market and you're overbought, you don't have to be anywhere nearly as concerned as you do when you're in a bear market when it rolls over, because these little rolls over are sometimes just 3-4% correction, which is totally normal. Only twice last year did we reach oversold. Actually, only once. We bounced right here on it. That's the sign of a true bull, and the stochastic reflects that. Just this correction in September, where we broke below the 50-day moving average. Look at every other time during the bull market last year that we bounced at the 50-day moving average. A lot of lessons to be learned from looking at past behavior in various charts. So back to today's indexes, let's go to mid caps. MDY, strongest of the indexes, but its 8 is flattening out also. Inside day today, however, still above the 200-day moving average. IWM small caps closed slightly below the 21-day yesterday, back above it today. Tight inside day, but while this regained the 21, you saw how the NASDAQ 100 lost the 21. So still in the same position relative to the 21, 4 out of the 5 indexes above it. Everything above the 50-day moving average, and the Dow and mid caps above the 200-day moving average. Here's the equal weight S&P 500, which has spent most of the past 2.5 weeks above its 200-day moving average. And definitely we'll be keeping an eye on that. Notice that for the most part, the relative strength has been even over the last 3 weeks, and we've just been consolidating, but this has been consolidating above the 200-day moving average, while the large cap S&P 500 is consolidating below it, and the NASDAQ lagging on a relative strength standpoint, as you can see by the negative slope of the relative strength line there. Let's look at the equal weight NASDAQ 100. Better, closer to the 200-day moving average, above its 21-day moving average. Relative strength much closer in line. Look how smooth the line is here. The equal weight NASDAQ 100 is really very similar in performance to the S&P 500. You can tell that by the flatness of that relative strength line. Let's go to a couple other key charts that we want to look at. The dollar bounced a little bit more today, actually started negative, finished near the high of the day, back above its ADMA. It's in oversold territory, and the stochastic has hooked up. This is something to be concerned about, because when the dollar is trending higher, this black line here is what's the S&P 500 doing at the same time. And for the most part, dollar up has meant S&P down. Dollar up, S&P down. So we're certainly paying attention to that inverse correlation. The VIX today came off a little bit, still trending below its 50, 200, and 21-day moving averages, and sitting right around this 22 level. Bounced a little bit above 20 yesterday after it closed near there on Friday. As far as bonds go, let's look at junk bonds first. Very often you can see any fear in the market relative to anything credit related showing up in weakness in junk bonds, but we're not seeing that yet. Still holding the 21. TLT, this is the price of the 30-year bond. Trending higher above the ADMA in overbought range. Let's look at the inverse of price, which is yield, the TYX. 30-year yield popped up a little bit today coming into its declining ADMA. It is in oversold territory. Hasn't spent a lot of time in oversold territory this year. So coming out of there would indicate the expectation that rates are going to rise back up a little bit. We'll probably know more about this when Powell speaks tomorrow. And finally, the 10-year. The 10-year TNX yield ticked up a little bit today. We're in oversold territory there also. How about GLD? Gold stocks had a pretty good day today. Gold just up about 0.5%. The stochastic has rolled over on that also, and Bitcoin BITO. Let's go to the 60-minute chart on there. Not a whole lot going on with Bitcoin, just kind of hanging out, going sideways, while another Bitcoin exchange filed for bankruptcy today. So supposed to be Andrew Ross Sorkin doing a big interview with scam bankman fraud sometime this week. We'll keep an eye out for that. So back to the tail of the tape, bear market rally, headwinds still intact. A little bit of deterioration on some of the technical indicators, put call 1.05, VIX around 22, still operating under this bull case, which we will unless the 21 gives way on the S&P 500. Some news, Europe stats this morning before the market reflected inflation slowing over there. We got a little bit of a pop pre-market on that, but ended up opening near flat. Then near 2 o'clock today, OPEC came out and said they're expecting a 2 million barrel per day production cut next month. That spiked oil a little bit. Day count, second day down. Powell speech tomorrow with Q&A is going to be huge. Expectations were neutral coming into today. We chopped right around that 39.50, which is the support area. Same situation support area with the S&P, as was for the NASDAQ 100, chopped basically most of the day after a tough sell-off in the morning. Let's go to the S&P and look at an intraday 5-minute chart here. And looks like we gave way, or we're going to give way here with this big sell-off after 10:30, but 39.40-ish area held support. Then we just bounced around that 39.50 area for the rest of the day into the close. So back to the tail of the tape, sector strong today: oils, metals, emerging markets, banks, real estate, gold, and gold stocks, mostly, not as much gold. It was only up 0.5%. Coal and transports. Dollar started out weak, then got stronger. That kind of coincided with the turn in the UUP. Higher coincided with the move down in the indexes. Bonds down, tech down, QQQ obviously lagged today, and utilities down also. Here's our focus list. We'll go through those stocks momentarily. I talked about the buying of the inverse ETF, QID. We sold First Solar. Why do we sell First Solar? First, let's look at the TAN index. This is the solar index, TAN. And it's just flagging here nicely, not bad after this decent move up, but it also broke below the 8, made a lower low. Relative strength lagging over the last week and a half. Again, review of the charts is showing that selling into strength has been the best move. We sold some at 170 last week, closed below the 8 yesterday, made a lower low. We took the rest off at 165, booked about a 10% gain on the second part of our First Solar. Yeah, it can come down, it can reverse and go higher. The stochastic is also rolled over, seeing a lot of that, but we booked the gain. We trimmed half of SHLS. Solars were generally on the weak side today, as this broke below its 8 also. Sold, still just sitting on a 1% position on this. We took a small loss on that also, again within our risk tolerance for losses. That 0.1% on a quarter on the first buy size, because this is a little bit more volatile. The buy was 1%. And then we added 5% in treasury bills, just rolling over from 1 week to later in December. So bottom line, choppy 1% range day around 39.50. Powell tomorrow, this 4007 key fib for now, broke back below it on 1128. Then 39.50, the second level down, is acting as support / resistance. We're battling back and forth. The next level down, the 150-day moving average, we actually touched that on the low end today at 39.37. Then we've got the 21-day moving average, which is up to 39.20. Then we've got the 100-day moving average at 39.19. Then we've got 3900, the round number, which was support on and off several times this year. So a lot of support on 3900 is the bottom line. And we, if that doesn't hold, the next level down is a full 100 points at 3,800, which is where the 50-day moving average is. But that 3,900, that would indicate a complete failed breakout from the last CPI number, the last CPI data that came out on 11/10, when we moved higher and have been consolidating since then. A break back below 3,900 would be a complete failure of that move. Out. So let's go to the focus list now, look at a couple of charts. This focus list is compiled from what I'm looking at and what the other guys on the team are looking at. AEHR continues. The three, over the last month or so, the three strongest charts in the market, AEHR has been one of them. I'm still kicking myself for getting shaken out of this, but the sell rule was legitimate, broke below the pivot, 8 rolled over, closed below the 21. Ideally, I would have held a small percentage of this, but at the time, the market was just starting to roll over a little bit on the indexes also, and the mistake was really not getting back in it. I had it identified as what I considered to be a leading stock, and it went on a very strong move. One of the strongest moves in the market as far as a stock that's a liquid enough to get into, although this is a little bit on the thin side. You know, harsh pullback, move back up. It's just been acting great, and you can see a little bit of jagged action around the ADMA. So this was a harder hold, but compare that, the other two that I'm going to bring up, that I think have been beautiful moves and very easy to hold. ELF was one of them. Alex has been talking about this stock for a while. Just look how nicely this trends above the ADMA, bounce there, but now a little change in character today, pick up in volume, above average volume, and it broke the ADMA. So this is something that been a very clear leader over the last 4 weeks, acted perfectly the way you want it to from its earnings gap. And now breaking the 8 EMA for the first time, another 5% down to the 21-day moving average. And then SMCI, Super Micro, another one that just acted perfectly since its earnings gap up. You got the opportunity to buy it on a pullback to the 8 EMA within the bottom of the gap up range, and then just continuing to ride this 8 EMA higher. Came down, didn't even touch today, down 1% today. I think an outside negative reversal. So that's a little bit of a red flag, but it's been in overbought territory for a while. You can see it stayed overbought back here during this entire move up. But this is what the action of leaders look like. They make a move, they give you another opportunity to get in frequently on a move back near the 8 EMA, and then just continue to be a risk-free and really a worry-free ride up if you're just riding it above the 8 EMA. This is what the best of the best stocks do, not trying to shake you out. So those are the three that I consider to be the easiest holds over the last month while this market has come off the bottom. Additional ones to look at in our focus list today: ON, again, a leader, very choppy, had a negative reaction to its earnings report. That negative reaction was short-lived, one closed below the 200 and then a slingshot up from 60 to 76, a quick 25% gain in about 2 weeks. Harsh pullback to the 21, bounced. Now a second pullback to the 21. You can't count on these 21 bounces to hold forever. The second one is obviously higher risk than the first one, and you've also got the stochastic rolling over here. ON, certainly a leading stock though. Relative strength also a little bit trending lower. One I'm watching just for now, a little bit too choppy. ANET, this is another one that we got shaken out of on the Zuckerberg day, but acted really nicely over the last two weeks. But then again today, stochastic has rolled over. I was starting with yesterday, rolled over below the 8, closed below the 8, couldn't get back above the 8 today. Little sign of weakness in some of these leaders over the last couple of days. We're seeing some consistency in that. Maybe it just means they pull back to the 21 and bounce. Maybe it means a little bit more. Again, we'll have a lot more information tomorrow when we see the reaction to what Jerome has to say. A couple other ones. When there were some gaming licenses, extensions granted in Macau, some nice volume over the last couple days on this. So definitely showing some strength there. Interactive Broker, this was on our watch list, or the 21 over 21 a little while back, had a very harsh correction here on 11/11. This was the day that all the safe growth stocks took it on the chin across the board. There was a rotation into growth on that day, but it has made its way back and back above the 21 and really just putting in the handle of this big cup and handle. Apple, definitely one to be concerned about. News out today that there could be as much as a 14 million iPhone 14 shortage because of all of the nonsense going on over in Foxconn, where they make them in China, although they did announce that they're easing the lockdowns in that area tomorrow, but that didn't do anything for the Apple stock today. Really needs to hold this 140 area, has failed for now at the 200-day moving average, and the moving averages are rolling over along with the stochastic. Market definitely needs Apple to act better. AXSM, this was a gap up yesterday, inside day today. So let's see if this follows the formula that, for example, SMCI did, where the first touch of the ADMA, maybe it happens in the bottom part of this, and that can provide a buffer for it to go higher. On the other hand, the market's going to have a lot to do with this, but what we're looking for is familiar patterns, familiar faces, familiar behavior out of leading stocks. Halo, certainly a leader. Again, riding the ADMA higher. Intraday shakeout below it here and here, but close above it. That's what you want to see. And then a higher high yesterday, inside day today. So begrudgingly giving anything back. I already showed ELF and SMCI, and that's going to complete the list for today. Other stocks that we're still holding in GROTECTION, Steel Dynamics, a little bit of a give back today, really just a consolidation, but around the ADMA. Again, very similar to what you're seeing in a lot of the leaders, a little bit of give back the last couple of days near the ADMA. PI continues to act very well, making higher highs for 5 straight days now on above average volume. Looks like it wants to be accumulated. Again, I keep telling myself, remember, selling strength has been the play in this market, but there's been no give back on this. I will probably let it trend higher above the ADMA before I lock any profit in on this one. Some disappointing action today in some of the things that we hold. GFS. Pulling back again, consistent behavior. You're seeing weakness the last 2 days, break of the ADMA sitting on the 21. Can't let this go any lower, or we'll be cutting bait with this one also. Celsius gave back a decent chunk today over the last 2 days, but still above the ADMA, down 4.7% today. But note volume is lower, so that was a positive sign. Mobileye, we sold half of this yesterday. This thing is just a bucking bronco. Closed below. It's got a 21-day exponential moving average now, and it closed below it. We're basically right a little bit below break even on the 1.5% that we have left, and I think that's going to wrap it. So, as always, love to hear from you. Email don@revereasset.com. Remember, it's not how much you make in the markets, it's how much of that you can keep. Recognizing the environment that you're in, knowing when to hit the gas, when to hit the brake, and when there's a big binary event like there is tomorrow with Jay Powell not pressing too hard in one direction or the other. So, wrapping up Tuesday, November 29th, this is Don Vandenbord telling it like it is. Thanks for listening and have a great day.